Lori Calvasina is here at Post 9, RBC head of U.S. equity. It's great to have you, Lori. Thanks for being with us. We were talking during the break about just what a difficult tape it is, right? Trends work for 2 or 3 weeks and then they work against you.
Yeah, no, it's true. And, it's interesting. If I look back to what happened, a couple weeks ago on the AAII survey, you actually went down for about 5 minutes and hit oversold levels in terms of how pessimistic people were. And then the very next week, we bounced right back up and didn't get quite into euphoric territory, got pretty darn close. And I would say the other thing that's jumped out at me recently is when we kind of kissed 5% on the bond yield, on the 10-year yield. I was actually out on the road that week seeing clients, and then it sort of fell very quickly. And people were like, it was like kids on Christmas morning. They're like, oh, my God, what do I buy? 10-year Treasury yields have peaked. What do we buy? What do we buy? And it was just like this sense of relief. People had felt so stuck for the last couple months, and now they had something to do. So, I think there is some, it's felt a little squeezy at times. But on the other hand, I think there was some real excitement that came about.
Is the theory that people will buy mega cap first and then go shopping elsewhere? Is that the working theory?
I think so. I mean, what's interesting, if you want to look at that what if yields have peaked shopping list, if you look within S&P, you're going to come up with the consumer discretionary sector and the communication services sector. Those are the two sectors that are most inversely correlated with yields in terms of how they trade. And consumer discretionary in particular, you can see this relationship all the way back to the 1980s. And those are big weights, and they're big weights in the growth trade. So it's going to push you back into those, kind of bigger cap growth stocks. On the other hand, another part of the market that should do really well is small caps, because they've been beaten down in large part due to interest rate fears and balance sheet concerns, but both can't really lead at the same time. So, it's a question, maybe you focus on one and then you focus on another.
Do you have a preference?
Which one do you focus on?
Well, I'm still telling people to have exposure to both. We like tech probably most of all within the growth trade. I have been telling people between consumer discretionary and communication services, I think you've got better valuations in comm services. So I think you still want to be somewhat selective. We're already down to 4.5%. Okay, how much farther are we really going to fall from here? But I have been telling people, I think once you get Fed cuts in place and we're a little bit closer to that, that will be a trigger for the small cap space. We've had some nice bounces here. They've had a good week. Is it really sustainable? It's hard to say when the economy is starting to show some signs of weakness.
Yeah.
But I think you're going to get caught flat-footed in small caps if you try to wait until you pick the exact inflection. So I think you want to go ahead and have some exposure and be patient.
And what about earnings? Obviously coming out of this season, but this idea of slowing and what it may mean for earnings and whether the multiple's justified right now. Where are you as we head into next year?
Yeah, so we just kind of did our almost recap of reporting season. Obviously, there are a few retailers coming out. And the thing I'll say, on the one hand, I feel I'm seeing a lot of challenge, uncertainty, complexity. So it does feel like the outlook is kind of soft. But at the same time, the consumer does seem somewhat resilient, rational, bending, but not breaking. On the other hand, I sort of look at the earnings numbers for next year. I'm at 232. The street consensus bottom up is 246. I've had a lot of conversations with investors about how the company level estimates are baking in too much margin expansion. And I'll tell you, the buy side is very skeptical it's going to come through. So I feel like we do need to pull numbers down at some point. That's going to cause some indigestion in the markets. And also, stocks have been moving well in advance of earnings trends. So if we get an earnings recovery next year, a lot of it's already in the price where we are right now. That doesn't make me super bearish, but, perhaps maybe dampens my enthusiasm just a little bit as reporting season winds down.